There are two strategies you can use to pass funding challenges. In this short video, I share with you the full details so that you can decide which strategy you're going to use to get you funded. Now, the first option is more of an aggressive passing strategy, and I'm going to run down the pros and the cons for this strategy. The first one is quite clear. You can grow your capital much faster. If you follow a more aggressive risk management strategy and you go through a trending period where you find yourself in a string of winners, then you'll find yourself scaling your capital much quicker, maximizing your profit potential. Aggressive trading can maximize your potential for higher returns per trade, which can be more attractive, especially in short-term trading environment. For example, if you target a 1-to-1, 1-to-2, or 1-to-3, you're better in and out versus someone that's targeting 1-to-10, 1-to-20 on a position. You can afford to be more aggressive knowing that you're in and out of the market fairly quickly. You can accelerate the learning curve by being more aggressive. You're going to come across losing streaks much quicker. You're going to find yourself hitting drawdown periods and seeing large negative numbers just as much as you'll see large positive numbers much quicker. Now, it's down to you to see that as a positive or a negative. Me personally, I think it depends on your nature, your character, your age, and your experience, not only in trading but also in life. If you're someone that has never been under any kind of pressure or gets upset easily, then this is probably not the route for you. And that leads me into the last point, which is psychological resilience, because successfully navigating an aggressive strategy can boost your confidence. However, this is depending on person to person, and again, it can swing either way. You can either take a string of losses and let it get to you, let it get under your skin and affect your emotions, or you can stay positive, neutral, and focused and prioritize the goal, build a thicker skin, and just get on with it. So in summary, although there is huge upside potential being more aggressive and risking more capital, there's also the downside and the psychological implications. So although with an aggressive strategy, there is huge upside potential and the ability to grow your capital quicker. However, on the flip side, it also has those negatives if you are inexperienced in the market or if you are biting off more than you can emotionally chew. Not to mention, it really depends on your financial security or financial situation. If you only have $50 to $100 each month disposable income, you're not going to do well. You're not going to be sustainably successful with an aggressive prop fund challenge strategy because you're going to be burning through accounts much quicker than if you were conservative. Here's an example of an aggressive passing strategy. If you risk 1% at opening balance, then once you lock in 3% profit on that account, increase your risk to 2% per trade until either one of two things. One, you pass the challenge, well done. Or two, you drop back below the 3% profit bracket and reduce your risk back to 1% and you repeat the process over again. If in drawdown, you simply keep at a 1% risk model and accept the fact that if you hit a losing streak or end up making emotional decisions, you lose the account and you have to start again. So again, that comes back to that downside that if you don't have money to lose and you're being more aggressive with your passive strategy, purchasing 3 or 4 funded accounts and expecting to pass 2, get your payout on those 2 and getting your refund back on those 2 accounts, and then taking a payout on the 4th, it can play out long term, but you need to understand that you should be only spending the money on the challenge fees if it's money you can afford to lose. Now, if typically a 100K challenge is around $400 and you're purchasing 2 a month and you're trading these challenges with an aggressive strategy style, there are other variables at play, like what's your strategy like? What's your win rate like? What market conditions are you trading in? Are we in a trending market? Are we in a range-bound market? What pair or instruments are you actually trading? What's your personal life like outside of trading? There are so many variables involved which you must input into this whole process of getting funded. Now, here's the second and more conservative route of getting funded. And I'm not saying either is better or worse. It really depends on your personal circumstances, which is why I'm giving you the pros and cons and the whole story and some maths equations and some examples of how this can play out. So first of all, risk management, because with conservative trading, it emphasizes more consistency, more long-term thinking, more discipline, more patience, and it instills good, healthy habits, which without a shadow of a doubt is critical for long-term trading success. In terms of consistency, this approach also can tend to lead to more consistent results, as it avoids the large fluctuations of the market, as well as how your emotions are being affected by large sums of money and high amounts of risk, which leads into the third benefit by a conservative passing approach: stress reduction. If you know you're risking less of the capital available to you and your odds of reaching daily drawdown or max drawdown are limited, your anxiety is going to be much more regulated versus a high risk approach strategy, which in turn will let your day-to-day life be more productive and be a lot calmer. And lastly, it's about affordability again. As long as you're not failing that challenge and buying a new one immediately, you're actually not failing any challenges over a 2 or 3 month period, which means you're purchasing around 4 challenges a year, which for most people should be affordable compared to being more risky, especially depending on your personal circumstances and your trading style and your emotions. You may be going through a funding challenge every single week if you're doing it too soon in your trading journey and if you're being far too aggressive with your risk. I would highly suggest you take the more conservative approach if you do not have any more than around $250 to $500 per month disposable cash to spend and to afford to lose on funding challenges. You don't want to be putting your grocery money on funding challenges or your rent or your mortgage or your fuel. You need to get everything else paid for first, which is one of the reasons why we tend to say don't quit your day job to be a day trader too soon, because you need to be able to pay your bills to regulate your emotions so that you don't need to trade, but you have the ability to. Now let's cover a conservative passing strategy example. If you start by risking 0.5% at opening balance, then once you lock in a 3% profit on the account, increase your risk to 1% per trade until one of two things. Either you pass the challenge, well done, or 2, you drop below 3% profit again, and then you just reduce your risk right back to that opening risk, which is 0.5%, and you repeat the process again. If you find yourself in drawdown, which is normal by the way, you keep to the 0.5% risk model until you get to a negative 3%. If you find yourself negative 3% or lower, just drop down your risk by half again to 0.25. And then you find yourself, this model will go from starting balance to max drawdown in over 30 losing trades. So if you're someone that is less confident in trading, has less capital to lose to put on the line, and is not very risk adverse, this is the better strategy for you. Like the saying goes, I keep saying, you either win slow or you lose fast. Losing fast is okay if you've got capital behind you and you've got a mathematical equation based on, if I purchase 4 or 5 challenges, I will pass 3 and get a payout on 1. The ROI on that is positive, but you've got to be able to have the skill set technically in the charts, but also the skill set to manage your emotions and to not let those financial figures get in the way of your financial goal of becoming a funded trader with putting that money on the line. If you're someone that is less risk adverse, then going for one challenge, passing one every 2 to 3 months, only putting on the line what you can afford to lose, and using this conservative passing strategy model would be more suited to you. At the end of the day, either route you are going to get funded. It's just a matter of time. The only traders that fail are the ones that quit too soon. If it takes you 3 months to pass a funding challenge, so be it. If the next person on Instagram is passing in a week, so be it. The important thing is to find a passing strategy that suits you, remain consistent and disciplined, and focus on yourself. Don't look around if you see other traders getting funded and that bothers you. If you find it inspires you, then great. Surround yourself with that inspiration. However, if it puts you down, go ghost and channel all of your energy into your plan. Let me know in the comments below what your prop firm passing strategy is like. Are you more risky? Do you live life on the edge? Are you happier burning through money to get a bigger ROI in a quicker amount of time? Or would you rather lay back, play it safe, conserve your capital, and get funded over a longer amount of time, keeping your risk to a minimum? I'd be interested to know either way. Neither are wrong. We're all individual. Thanks for watching, and I'll see you on the next one.